Hi guys, and welcome to G-Economics. We've had a little bit of an Easter break, but now we're getting back into it. I hope that your revision has been going well over the Easter, and this video is picking up where we left off with regard to the GCSE A593 papers. That's paper 3, working through the stimulus material, and of course we had reached, if you recall, we had reached this figure 9 where we have the data set for 4 commodities, as you can see here. Do remember that this data set figure 9 is very closely linked to the full page extract which goes before this and precedes it with regard to figure 8. So there is a link between figure 8 and figure 9, ladies and gentlemen. So let's just take a look first of all of the questions which I have been working through with my students in anticipation and preparation for this data. So figure 9, calculate, directive word highlighted for you, the percentage change in price in each of the commodities from 1990 to 2015. Again, this whole notion of being able to calculate a percentage is a very straightforward skill, but yet so badly done by so many candidates year on year. So let's make sure that we can do that. Explain why a reduction in the price of copper would be so catastrophic for Zambia. Now, I'm really not going to go into that in much detail in this video because I covered that a lot in figure 8. So I'm not going to say too much about that here. With reference to the first 3 charts, explain why in the last year the Australian dollar will have lost 25% of its value against the US dollar, and that relates specifically to figure 8 where it actually references that here. It says any economy dependent on commodity exports has seen its currency depreciate. Australia, whose iron ore, coal, oil and natural gas provided the raw materials for the Chinese boom, has seen the Australian dollar lose more than 25% of its value against the US dollar over the past year. And what might be the reasons for that? So that's where we're getting that question from. With reference to the demand for Zambia's exports, use an exchange rates diagram to analyse, keyword analyse, why the kwacha has lost 45% of its value in the last year. Again, I looked at that quite significantly in figure 8 video. If you haven't already seen it, go to the playlist and you'll find that one and have a look through that one. And then lastly, using an exchange rates diagram, analyse why the kwacha, the Zambian kwacha, would be affected by the mining company's decision to lay off more than 9,300 people. So, those are the questions which I'm going to look at in this particular video, ladies and gentlemen, and without further ado, let's get right into it. So, first of all, as I've already pointed out, figure 9 links to and follows on from figure 8. So make sure that you're looking at these 2 extracts, these 2 figures, in conjunction with one another. Look carefully at the data, ladies and gentlemen, on figure 9. And you will see that these are all being expressed in US dollars per barrel, US dollars per metric ton, US dollars per metric ton, US dollars per metric ton. So that's just an important point of info, really. And what are we looking at in each of these charts, the 4 charts? It's the average annual prices of a particular commodity, be that iron ore, copper, steel, whatever it may be. Okay. If we go back to the first question, which I have shown you on that Word document, we're talking about calculating percentage changes across periods of time. So if we take, for example, the price of crude oil per barrel, in this particular instance, 1990, we'll call it around about the 20 US dollar mark. Fast forward to 2015, having experienced quite significant rise through the early noughties anyway, the early 2000s. It then dropped off and finished around about, let's call that 45. So in terms of calculating our percentage change, so it's gone from crude oil price per barrel in USDs, US dollars, from 20 to 45. So obviously, in terms of your calculation, ladies and gentlemen, you're looking at working out, well, 45 over 20 could be one way of doing it. Or you're looking at working out the difference between those two numbers, so that's 20 to 45, so that'd be 25 divided by your original number and multiplying by 100. Now in both instances, regardless of which way around you do that and which way you've been taught to calculate your percentage change, you'll find that that is a 125% increase. So just make sure, ladies and gentlemen, that you are able to carry out a very straightforward percentage change, nothing more to it than that. I do think, ladies and gentlemen, it's worth just looking at this data for a moment just to see what's happening across the time period in each of the commodities. You can see really the general gist of this, and the general trend is that really you've got a sort of flatlining of prices through the 1990s. Then once we get to the 2000s, the noughties as we refer to them as, we then see a real pickup from the early noughties through obviously to 2007, 2008. So increasing prices, increasing prices down here as well. But then of course what happened 2007, 2008, the Great Recession as it's come to be known, and at that point then we see these very significant spikes in the data. So very significant reductions, drops off as a consequence of the financial crisis. Then things recover a little bit, but then as we see, and as it's referenced in figure 8, the slowdown in the rate of growth in China. China of course has been hoovering up all of these natural resources, and so countries which are rich in natural resource have experienced a commodity boom because China have wanted to buy all their natural resources. The demand has been very high. And as a consequence, when demand is high, that obviously pushes prices up. So if we think of that in terms of a simple demand and supply diagram by way of analysis, if you think about what would be happening on the demand side in the noughties, well, our initial equilibrium would be here, P1, Q1. As China's growth, but not only China, the BRIC nations, Brazil, Russia, India, China, South Africa, etc., as they all start to pick up in growth, their demand for natural resources grows as well, because of course the demand for natural resources is, ladies and gentlemen, as I'm sure you recall, it is a derived demand. The demand for natural resources comes from growth, in this case. And so the demand for natural resources might shift to D2, and as a consequence the price rises to P2, with quantity demanded and supplied rising to Q2. So in the good times, if you are a country which is very well endowed in natural resources, and you've got BRIC nations growing, tiger economies growing, then that's great, isn't it? Because the price of your commodity will rise and hence your export revenue rises, and so on and so forth. However, and we've considered this in previous videos with regards to this extract, if the demand for these commodities starts to fall and growth in the fast-growing BRIC nations starts to slow down, then obviously the demand for these natural resources starts to fall. And so rather than demand shifting right, demand then shifts left to D3. And you end up with a lower price and a lower quantity demanded and supplied. Now, if you are an economy which has got a very diverse range of production and areas from which it can earn revenue, then that's not a problem. However, if you are a country like Zambia, which is very, very heavily reliant upon the export of copper for its revenue and for its employment and so on and so forth, this movement to D3, P3 and Q3, that's obviously very detrimental to that. I think it's also just worth mentioning, ladies and gentlemen, with regard to the supply side issue here, when we look at oil, for example, and we look at what's been happening to the price of oil. It's important, I think, to consider just the supply side elements which will be impacting the price of oil. Obviously demand will be playing a role, but let's not forget the supply side here. So I've highlighted this one here just specifically for the price of oil. So if you think about the supply side and the factors which are impacting on the supply side with regard to oil, obviously we've got OPEC, the oil producing and exporting countries. They certainly a number of years ago, a couple of years ago, they turned the taps on with regard to oil and increased the supply. We've also got to think about fracking, this new technology which allows oil extracting mining companies to extract reserves of oil which were previously very difficult to obtain. And fracking in the US particularly has taken off, and again that has very much increased the supply of oil. And we've also got to remember Iran, very much in the news at the moment, obviously, with Trump and what's going on in Iraq and Iran and Syria and so on and so forth. But Iran, you'll know that the American government, the US government, lifted the sanctions which had been in place on Iran. Now those sanctions prevented Iranian oil from flooding the markets, but when the sanctions were lifted, Iranian oil was then set free, set loose. And so the combination of all of these factors is had been certainly very much increasing the supply of oil, and so supply in the case of oil was shifting to the right, hence price falling from P1 to P2 and quantity increasing from Q1 to Q2. So in terms of oil, it's not only a demand side factor, but it's also a supply side impact, and one reinforcing the other there. So it's just it's an important point, I feel, for that one. Okie dokie, ladies and gentlemen, let's move on from that. So the next question I'm going to tackle is this one here with regard to the Australian dollar. That's Australia, that's specifically for Mr. W.G. Clark, that, by the way. In the last year, the Australian dollar will have lost 25% of its value against the US dollar, and I've already shown you where that comes from in the extract material. So we need to just consider this in terms of the demand for coal, for example. So if you look on the extract here, Australian coal, we can see that the price of Australian coal since around about late 2010, early 2011, it's fallen by about 50% indeed. So it's gone from 120 to 60 US dollars per ton, per metric ton. So that's primarily, certainly from what's given in the figure 8 extract, due to a lack of demand for Australian coal. And of course, if there's a lack of demand for Australian coal, the demand curve, if we think of a start point of P1, Q1, the demand curve will be going left and the price of coal will be falling. But what else will be happening, ladies and gentlemen, to the demand for the Australian dollar? If the demand for coal falls, then there are fewer countries buying Australia's coal. That means that fewer people require the Australian dollar, and therefore the demand, ladies and gentlemen, the demand for the Australian dollar will be shifting to the left, potentially. So we will be going from D1 in our diagram, D1, to, let me just bring the pen up, ladies and gentlemen, we're going from D1 to D2. And as a consequence of that, ladies and gentlemen, the price of our currency, specifically in this case the Australian dollar, will be going from P1 down to P2. quantity demand and supply going from Q1 to Q2. Now you'll be aware, of course, by now in your studies, and you'll be really up to date on this now, you'll know that this is referred to as a depreciation of the Australian currency. And indeed that's what it says in figure 8. It talks about the fact that the Australian dollar has lost 25% of its value against the US dollar. And primarily because the demand for these resources which are being pumped out of Australia, the demand is falling, therefore the demand for the Australian dollar falls, hence the demand for the currency falls, hence the value of the currency depreciates. So that's our answer for this one. Question 4. With reference to the demand for Zambia's exports, exchange rates diagram to analyse the reasons why the value of the kwacha fell by 45%. Now I've covered that in quite some detail in my video for figure 8, so I'm not going to do that, but suffice to say that's to do with demand and supply side effects on the exchange rate. And then lastly, analyse why the kwacha would be affected by the mining company's decision to lay off more than 9,300 people. Now, I've been reading over the Easter holiday, ladies and gentlemen, some really interesting material about exchange rates and currency movements and so on. And if you think about it, a country, if it decides we're going to lay off 9,300 people, that's enormous, isn't it? Well, that really is a surefire indicator to the rest of the world that things aren't going too well in the economy. And people who were holding the kwacha would then think to themselves, well, this looks like a surefire bet that the value of the kwacha is just going to lose its value, it's going to depreciate, depreciate, depreciate. And therefore, if you are holding the kwacha, you'll be thinking, well, the very first thing that I need to do, the most immediate thing that I need to do, is I need to sell my holdings of the kwacha. And as you well know, ladies and gents, that would mean that the supply curve would shift to the right. So let's just do that. The supply curve would shift to the right. S1 to S2. S1 to S2. And as a consequence, the value of the kwacha would fall from P1 to P2. So this really, ladies and gentlemen, this is about confidence in an economy. Why does the UK's currency, generally speaking, hold its value quite well? Because people globally, investors and speculators, are confident that if they put a whole bunch of money into UK sterling, it is not going to just lose its value overnight. People have confidence in it. When you announce to the global economy that you're going to lay off almost 10,000 people, that is not a sign of confidence, is it? And so people, investors, speculators, will ditch their holdings of the kwacha. Indeed, it would lead to, ladies and gentlemen, as you may well know, it would lead to an outflow of hot money. As investors ditch the currency, it would lead to maybe something called capital flight. Again, as people abandon that currency and they sell it off, and so the supply shifts right, the value of the kwacha then depreciates. So that links in, ladies and gentlemen, quite nicely with what